Great to have you on the show.
Thank you. I really appreciate the invite.
Absolutely. So, David, I wanted to talk to you about the municipal bond market. I recently read an interesting story in which I heard that the municipal bond market is facing somewhat of a shortage of bonds right now because new issuances are down while demand is still pretty high. So it seems like demand is outstripping supply. Is there any truth to that? And I'd love it if you can give us kind of the broad overview of what the muni bond market looks like right now.
There are three considerations when people are thinking about munis that should always be of mind. One is we're very technically driven, which means supply and demand are often very influential. The second is that structure of what you're buying really matters because of the tax exemption of the bonds. And then lastly, there's an inefficiency that exists in the muni market because it's very broad, diverse, and complex. And that creates a lot of mispricings. Now, in that context, going back to number one, technicals, yes, issuance this year is down about 14%. It's interesting to note that in August, if we look at August this year versus August last year, supply was about equivalent. And August supply was about 34% higher than it was in July of this year. And the expectation is as we progress through the rest of this year, we'll see issuance pick up. Now, normally one would say, okay, well, lack of issuance suggests that, supply is tight. That should put pressure on prices upwardly. And we see that perhaps in some measures like muni to treasury ratios, where you look at the muni yield divided by the treasury yield. We can talk about that in a minute, but at the end of the day, it's also important to note that right now our outflows for the year are about $10 billion from mutual funds. So mutual funds tend to be kind of the marginal buyer in our market. They tend to dictate pricing. Now, this time last year, outflows were $84 billion. It was an exceptionally tough year in terms of outflows. But certainly right now, we're not seeing the issuance, but at the same time, we're not getting a lot of inflows. I think if we had positive inflows, the lack of supply would be much more obvious in terms of relative pricing.
So you did mention a second ago, David, how the muni market is very diverse, very complex. So given that, where are the opportunities today? Because not all munis are the same. Obviously, there's a big gap between, general obligation munis and, individual projects. So where are the opportunities?
Sure. So every year we come out with what we call our 5 municipal insights. We do this at the beginning of the year, and then we do an update mid-year. And in that, we share with our clients what we think are the factors that are going to drive the market over the year. And that really kind of speaks to where's the value. And for all of the portfolio managers at MacKay Municipal, it also acts as a roadmap for what we want to be doing in our client accounts. When we look at value in the market today, what we see is a couple things. One, I call it the 3 to 10 year, 3 to 12 year part of the municipal yield curve is exceptionally rich. Because I think a lot of people think that the muni yield curve, that, the yield per maturity going out, is basically mimicking the treasury yield curve, but just at lower yields. And that couldn't be farther from the truth right now. So from 3 to 12 years, roughly, munis are trading at very rich levels. This is being driven by a high level of demand by what are called, wrap accounts. Those are accounts where an individual has, let's say, $250,000, and they've hired a professional manager to buy bonds for them and create what becomes effectively a laddered portfolio. Well, there's so many people doing that the demand for bonds is very strong in that front end of the yield curve, and it's made it quite rich. So from our perspective, that's a danger zone in terms of just being too little yield for the amount of rate risk duration you're taking on. We prefer to look at the, call it 15 to 25 year part of the municipal curve as an area where we see upwardly sloping yields. So the yield curve is back to its normal shape, meaning each successive year you're being compensated a bit more for the risk you take. In that part of the market, we like bonds that have coupons that are 5% or higher. And specifically, late last year and into this year to some degree, we've had the ability to buy 5 1/4s, 5 1/2s, 5 3/4 type coupons for the first time in years. And we like that structure for a couple of reasons. One is if you owned 4s and you went into 5 1/2s, you instantly bring down your rate risk, your duration. The second is we do expect, and we even saw it this year to some degree, that the issuers aren't going to keep coming with that type of coupon structure. So there is a scarcity value that develops in those bonds. So structure means a lot, and it's really important from a standpoint of thinking about tax. Now, a value trade this past year and a half, which isn't so much what's attractive today as much as what has been done, is the tax swap trade. Doing trades to take advantage of a down market to swap out of bonds where you have a loss, so you realize that loss, and you go into a similar bond that has also experienced a loss, but you're buying that bond at a much higher yield than your first security. And what you end up doing in that trade is you realize your loss, which you can carry forward against future gains. That gives you a lot more flexibility in your investing, and you're increasing the accrual rate. Last year at MacKay Municipal, for example, our trading activity in 2022 was over 300% of what it was the prior year. And it was largely due to doing these accrual increasing trades. So that's been value. We are cautious about credit. One of the things about rates rising over the last year and a half is that for the first time in quite a number of years, we have the capacity to buy higher quality bonds without having to sacrifice yield to do so. And we specifically have been able to move into sectors that are more what we would call core sectors of our market, like general obligation bonds, water and sewer, to some degree electric utilities, where we are able to go into higher quality bonds at better yields and get back to what is kind of known as the core part of the muni market.
Fantastic, David. A ton of great information. Thanks so much for your time and sharing your insights with us.
Thank you.